although we've seen stocks returning from the recent lows, there's still a high disconnect between the public and the private markets, especially when it comes to the high growth companies with a lot of future still ahead of them. Today we're going to look at two examples. We're going to look at Voyager Digital, and we look at Hims and Hers, and we look at the valuation discrepancy between those two companies and comparable other two companies in the private market. And then we're going to figure out why is there this discrepancy and which side of the coin is right here. If you're new here, I'm Robert. Welcome to the channel. If you like this type of content, please consider liking and subscribing the video. But without further ado, let's hop straight into it. So we've seen the market today quite green across the board. Really much everything goes up other than sort of the oil and health sector. But all the big tech and growth companies had a really impressive day. And we've seen sort of a comeback from the recent lows where, you know, there was just really a lot of fear out there, and the recent lows were just impressive. So even stocks like Microsoft, Apple, Google, like those were sort of starting to look like deals in that type of environment. Now those ones have recovered to their recent highs, but there's still a lot of opportunity out there when it comes to high growth, tech, fintech stocks, especially looking at things like Voyager Digital, a crypto platform. They had their highs at around $30 a year back, where it's now trading at $7, representing a $1.5 billion market cap in Canadian dollars. And we were also going to look at Hims and Hers, obviously big stock here on this channel as well, and had their highs around the $15 range. And when they were listed, actually even higher, around $25. But yeah, a year back ago, around $15, now trading at $5, representing a US dollar market cap of $1 billion. Both of them have partly recovered. I mean, I want to say like quite, carefully, partly recovered in the last couple of days from their recent lows. I mean, Hims was trading under $4, and Voyager we had not seeing as strong as a recovery as I would have hoped, or I would have thought so, because given that crypto had a quite strong rebound and was actually now playing with the $50,000 range. So yeah, I mean, the stock price went down to all the way down to $5.55, now around $7, so there's kind of a rebound. But if you zoom out, it's still way below their all-time highs for both of them. But what I actually found was that, if we're looking for Hims, like a competitor to Hims would be a business called Ro. It's private listed business, and they're making progress in the telehealth space, and it's kind of a comparable company to Hims and Hers as well. And they've just raised money. So this is a quite new article from last month. They raised money with existing investors to double down on Ro at a boosted $7 valuation. So if you think about that, a comparable business, and you can read the article as well. I'm not going to go through the detail here, but it is a comparable business to Hims, looking at a $7 valuation. And investors or existing investors seem to be happy to pay that and seem to be happy to invest that, and all that in the private market. And as you just saw, Hims valuation right now is around $1 billion. And it gets even crazier when you look at a business like FTX, also cryptocurrency broker out there, bigger than Voyager, but comparable in terms of member numbers for the international part. So they've just been raising money in January this year at a $32 billion valuation. If you compare it, it's absolutely crazy, absolutely nuts. So we're talking at a comparison to Voyager Digital, which obviously, yeah, it's just operating in Canada and the US at the moment with expansion plan on the horizon, but still they're not nearly as small as it would seem. If you look at the valuation here, $1.5 billion valuation compared to FTX, which just has been raising money at a $32 billion valuation. And that's, yeah, despite the bear market fears. So this is exactly right now. This has happened 2 months ago. And for Ro, it happened 1 month ago. So this is in the midset of this fear around recession, interest rate hikes, and the war that's going on. Still, in the private market, we see these types of valuation levels at which money gets raised. So there's obviously a huge disconnect here between, let's say, on the one side we have public stocks that just get heavily crashed, discounted right now, lost 80 to 90% of their all-time highs, trading now at around $1 billion plus, whereas we have on the other side businesses trading for multiple of those. I mean, compare HIMS 1 billion to $7 billion Ro, and then compare 1.5 billion Voyager Digital to 32 billion valuation of FTX. And even more so interesting for FTX is that they had another valuation round just happening in October last year, where the valuation was. And even more interesting for FTX, they had another capital raise happening just last year in October, and that valuation was $25 billion. So now we're looking at a $32 billion in just a couple of months, basically. So we had that increase of around $7 billion in valuation, which is sort of, 3-4 times Voyager's actual market cap, just for a few months in between the capital raises for FTX. So that's quite interesting. So, and then I found this, commentary from Kathy Wood from ARK Invest. I thought that kind of explains it quite well. So let's check that out. Let's get her take on why is there a disconnect between private market valuations and public market valuations, and who is right in the end.
The private markets know it, because private market valuations have only gone up over the last year. We're writing a paper gathering the data on this right now, but in the last year, as true...
And also just to mention, Kathy Wood is actually working on a fund that will trade as an ETF, where you will be able to invest in privately held businesses. So that's going to be very interesting to see.
Disruptive innovation strategies depreciated 50% or more. Private market, which is which focuses on disruptive innovation, private market valuations seem to have doubled. There's really something wrong with that picture. And I think the private markets have it more right. There's more innovation taking place today than there ever has been in history.
And this is what she's basically seeing here. So she sees that huge disconnect, that everything called innovative, high growth, but loss-making gets just heavily discounted in the public markets right now, where there's just this, heightened fear around inflation, recession, and so on. So they're basically saying, all those kind of futuristic businesses, they're not worth as much right now. I don't want them. I want a secure business that is has market control, has pricing power, has high free cash flows, and so on, high profitability. This is what she sees here, but apparently in the private market, still huge bets are taken on those companies, on those futuristic companies with loss-making situations at the moment.
If you take a look at our Big Ideas 2022 webinar, which we spent 5.5 hours, it's up on our site, it's on YouTube, 5.5 hours, our Director of Research, Brett Winton, and all of our analysts describing how provocative and profound these changes are going to be. I often use that during the tech and telecom bubble, I was in the markets at that time, of course. I saw investors, falling all over each other, trying to one-up each other to get a bigger tech position, because tech in the indexes had moved to 35%. So we saw many portfolios with 40, 50% tech. Again, they needed to outperform that index.
So how she's comparing it to the 2000 bubble is saying that back then it was more like ideas, big ideas with futuristic kind of business models that would change the world, but none of them had real revenues, none of them had real growth. Whereas the innovative companies right now that, something like a HIMS and Voyager, they already have that revenue, they have this massive growth, they have these huge margins. They're already operating in a functioning business model. And the only reason why they're making a loss right now is because of the expansion, higher marketing costs and so on for both of them actually. So that's why they're making loss, and they are not sort of bubble stocks where there's just an idea there. There's a real business with real customers.
And of course, that was exactly the wrong thing to do. But it was mass psychology. It was a very interesting time. Today, we have the same thing going on in reverse. We have investors shying away, in fact, running for the hills And the hills in this case are their benchmarks. Everyone needs to get close to that benchmark. And they all look alike. If you look at the top 10 in NASDAQ, top 10 in S&P, the overlap is astonishing. These benchmarks have really, I think, done a disservice to the allocation of capital.
So yeah, what she's explaining is that everyone tries to chase index performance. So to be in line with market performance, they're shying away from innovative stocks to avoid making a loss, or like it looks like an unrealized loss in that 1 year. But the only way you can outperform the market is to actually go into these, you know, contrarian positions as like a HIMS or Voyager, where not everyone agrees right now, but they might agree later once they see the potential. That's the only way you can make, you know, a 10x gain in the market. Because if you always are in line with the market, you're never going to be able to outperform the market.
But that said, investors are running for the hills when there's volatility, fear around inflation and interest rates. And we think that decision is going to prove to be just as incorrect as the decision to move en masse in the late 90s.
What she's explaining there is, so there is this huge disconnect where she sees that the private market has gotten it right, more right so than the public market at the moment. Obviously, doubling up valuations in a short time span is probably also not right. So there seems to be quite a hype in the private market with a lot of cash available, so that, you know, they're looking for a place to put it, basically, so that, you know, there is a kind of a hype situation going on there, whereas there's the opposite happening in the public market. So probably we're going to meet somewhere in the middle. But if you look at something like a HIMS and Voyager, that just purely seems to me that there is a double to triple X opportunity out there right now if you invest in these levels that they are trading right now, when those valuations will meet in the middle. So for instance, when we have a $1 billion HIMS valuation meeting with a $7 billion Ro valuation meeting at a $3 billion, we've got a triple up from existing prices. And similar to Voyager, where the opportunity is even bigger, given their strong revenue growth and given their expansion plans, to meet FTX's type of valuation, which is $32 billion, and they are only sitting at a $1.5 billion. I think that's one of the most undervalued stock opportunities out there at the moment. I'll hope you look into it and you will see what I see, but let me know in the comments if you see any other type of stock situations where you have a privately listed and a publicly listed stock. We see a huge discrepancy out there. If you know of anything else, it will be interesting to see that. And I hope you enjoyed this video, and see you next time.